Hello, everyone, and welcome to today's incredible session on Venture Finance Trends with Wilson Sonsini and special guests. If this is your first time joining us, we're so glad to have you here. My name is Nicola Corzine, and I am the founding executive director of the NASDAQ Entrepreneurial Center. We are a nonprofit who are committed fundamentally to helping entrepreneurs worldwide achieve their greatest visions, thrive, and survive in the great times and in the challenging ones. Today's session is here to talk a lot about venture financing, what is going on with it right now, and how as entrepreneurs you can successfully navigate through some of the unknowns. And along those notes, you can't do this journey, as I'm sure you all know, alone. And on that note, hopefully you have seen in the chat and in the opening video our commitment to mentorship. If you have not yet seen or signed up for Mentor Makers and have capacity to give, whether as a mentor to help entrepreneurs be successful in this journey, or you're looking for a little extra help in figuring out how to be successful in developing and finessing your financing strategy, your business development needs, sales, talent, whatever the aspect may be, we'd encourage you to sign up and apply. This is, as always with everything for the center, a free offering and resource that is made available just for you. So we'd love to see you online and taking advantage of this incredible resource. Everything that the center does would not be made possible without all of our supporters, our champions, our allies, those who give up their time, their talents, and their treasures. So for all of our sponsors, we say a deep thanks and appreciation for all you do for us each and every day. During these times, and since the start of the pandemic, we always start every single class and offering that we do by checking in with how you are all doing above all else. So I'm going to launch a very quick poll, and I'd ask you to take just a moment to share with us how you're doing right now. Obviously, this market climate and conditions has not been an easy one. It has been a long and ongoing journey that you are all on. Your insights here help us figure out what programs to bring forward and how to prioritize your wellness above all else in all of our classes and programs. So we appreciate your honesty and your earnestness in giving us these insights as we go through. Always we see a healthy dose of optimism from our entrepreneurs. Today is no different, but rightfully and understandably, we're also seeing an increase right now in anxiety and honestly in holding on from a survivability perspective. We want to end this poll right now, and I'm going to share those results with all of you so that you can know you're not alone in this and that there are other entrepreneurs who are feeling just like you. Thank you for taking that time. I've got one more poll that I'm going to be launching a little later on, but for now, we're going to get to the exciting content part of this journey. We have, as always, an incredible guest joining us today. Craig Sherman is a partner at Wilson Sonsini. He has been doing this with us for the last few years now, an incredible expert in helping us really see around corners when they're almost impossible to see around, but yet somehow Craig does that always with a healthy dose of enthusiasm and insights. So Craig, welcome back. Great to have you here. And I'm going to invite you to turn us over to the Entrepreneurs Report and what you're seeing from top level insights right now.
Great, Nicola, thanks so much. It's great to be here again and to be talking about the latest trends. One of the things that we do at our firm is that we track all of the deals that we work on, both company side and investor side. And we put out a report on a quarterly basis of the different deal terms and how deal terms are evolving over time. I see there is a link on the right in the chat to the Entrepreneurs Report. This latest report for the second quarter of 2022, ending June 30, just came out yesterday. So you're among the first to be seeing this information. We're going to walk you through a couple of slides on kind of the latest and greatest of what happened here, and it will confirm what Nicola already has been hinting at. Some of this and what I'm going to talk about here is just a numeric confirmation of what I'm sure many of you have been seeing and feeling in the market. Some of this may be a little bit surprising. It was a little bit surprising to me. This first slide is the one that is not at all surprising, that we track the number of up, down, and flat rounds on a quarterly basis. An up round is a financing, a second or later equity financing, where the price per share is higher than the last round. Obviously, every company would like every round to be increasing in value, but that's not always the case. A down round is the opposite, where the price per share has dropped compared to the prior round. And then a flat round is a financing that essentially is a reopening of the last round. Sometimes it's called the same round and it's just reopening the same Series B or Series C. Sometimes it has a different name, but it's the same price per share. And what we're tracking here is the price per share compared to the prior round. What's interesting and here, and I think we all felt it, and I talked about this the last 2 quarters, that Q4 of 2021 was peak market. And you know that it's peak market when every single financing that we worked on was an up round financing. We did no down round financings, no flat round financings in the fourth quarter of 2021. The price per share increase in every single financing we worked on. We've been tracking these numbers since the 90s. That has never happened before. So it was extraordinary. Our initial numbers, if you attended last quarter, our initial view of the numbers for the first quarter of 2022 was the same. We actually had some reports from some of our deals come in late after we had already put out the report, and we've revised the numbers here. There were some down round financings in Q1. And then as you can see here, the number of down rounds fell to just a little bit more than 80% of all the financings we've worked on, which sounds bad, but in some ways, if you look over the last 5 years, back to the first quarter of 2017, that's very middle of the road. And it in fact, I view it as a healthy, as a sign of a healthy market, that not every single financing is an up round, that there is a recognition that sometimes companies fail to perform. And when you fail to perform and you need to raise your next round, the valuation will drop, and that's an okay thing. So we're actually now in Q2 reverting to something that's more normal. And you look back, Q2 2018 was worse. There were more down round financings in that quarter than there were in the second quarter of 2022. Based on what I'm seeing in the third quarter so far, now that we're the halfway into it roughly, is a continuation of the same, that I suspect when we have the final numbers for this quarter, this will look very similar. Why don't we jump to the next slide? And we'll talk about valuations. So here's where it gets interesting. The part that's not surprising and is quite dramatic is what's happened to valuations for late stage rounds. So the dark red line is Series C and later financings. You look at Q4 2021, the median valuation of a Series C and later financing that our firm worked on was over $1 billion, which is shocking. Now, the numbers were high earlier in the year, but it just skyrocketed. In other words, every single Series C and later deal we worked on was for a unicorn company. That dropped in Q1 from $1 billion to 600, which is high by historic standards. That was still the third highest that we'd ever encountered, with the second highest being Q1 of 2021. But look at Q2 of 2022. The median valuation dropped to 270 million. So the median valuation of private companies and deals that we worked on for the late stage deals dropped 75% in 6 months. I mean, that is astonishing. The NASDAQ, the public market has declined. A lot of SPAC deals have declined, and this looks very much like what we've seen in the market for companies that were able to merge with SPACs and how they performed in the aftermarket. That 75%, trading 75% below where they started is pretty typical, and we're seeing this in the private market. Now, the flip side of what's interesting here, and what kind of surprised me, I was sensing this a little bit, but the numbers confirm that. Look at the 2 bars on the left here in each chart, the light gray and the black bars for the early stage financings. The gray is the seed financings, the first priced equity round. And the black bar is the Series A, which these days is usually the second priced equity round. And valuations went up substantially for the early rounds in Q2 of 2022, from 10 million in that Q4 of 21, which was the peak quarter for late stage valuations, to 18 million. So seed round valuations almost doubled in the last 6 months, while the late stage rounds fell by 75%. And also the Series A deals went up just a little bit over the last 6 months from 45 to $48 million, but still very healthy valuations here, in part because the valuations, if you look out over the prior couple of years, they've been going up, but they hadn't bloated nearly as much as the valuations of the late stage companies. We don't publish our quarterly number of transactions, but I'm sure you can sense that what's going on here also reflects in the deal volume, not just in the valuations and in the amounts raised that we'll talk about in a moment, but the number of early stage deals went up meaningfully in Q2. And so that market has been very healthy, not just in terms of these numbers, the dollar numbers, but in terms of volume. The activity is very, very healthy, and we're feeling really good about that. And my own experience has been that the last 6 months has been the busiest I've been with seed and Series A deals that I've been in years, probably 15, 20 years. That has really blossomed as investors have shied away from the late stage deals. And again, the dollar numbers are also reflected for the late stage deals in the deal volume. The number of late stage deals is down meaningfully based on our own data and the data that other sources like PitchBook and Crunchbase have been publishing. So why don't we jump to the next slide? And we'll talk about median amounts raised in equity financings. You can see, again, similarly, the median amounts raised in late stage rounds has dropped a little, but again, if you look out over the since Q4 of 2020, the beginning of our time to being adjusted to the pandemic, deal sizes for the late stage rounds have really increased over the last year and a half compared to the historic levels. And on the left side of the charts, I hadn't mentioned, but hopefully it's obvious. Hopefully this is big enough on your screen that you can see the periods. But on the left third of the chart is year over year, 2017 to 2021, and then the right 2/3 is the quarterly since the first quarter of 2020. You can see that the late stage rounds, the amounts raised have been very high. There's just been a lot of dollars flowing, whether that's from traditional funds, and a lot of what the activity that we saw was crossover funds and other late stage funds, the Fidelities of the world and T. Rowe Prices, investing in late stage private company rounds. And a lot of the reasons that valuations and deal sizes are starting to drop is those late stage investors who typically would have done public company deals had moved over into late stage private, and now they're moving back towards the public markets as they're seeing better valuations there, and they're moving away from the late stage market. Now, if you look again, similarly to what I was talking about earlier on valuations for the early stage deals, the early stage companies are also raising very large rounds. So the median amount raised in a Series Seed round, $4.5 million compared to $2.7 million in the prior quarter, and nearly $10 million for Series A deals. So the early stage companies are in good shape right now, and we're feeling good in Q3 as well. That these trends have been continuing, where the early stage rounds are looking quite healthy. So let's turn to bridge financings. For those who aren't familiar, a bridge financing is a debt financing that will convert into the next equity round. So it's a way to raise money relatively quickly on simple terms, either before the first priced equity round or in between priced equity rounds. You see two bars on the chart here. The gray bar is the pre-series seed financing. So the first convertible note financing before a company has raised a priced equity round. And then the red bar is bridge financings in between rounds, which could be between a seed and an A. It also could be between a C and a D financing. And interestingly, the amounts raised in both the pre-seed and the later rounds, bridge rounds, dropped meaningfully in Q2. And I think this reflects, again, that there's been heavier activity in the earlier stage where bridge rounds tend to be relatively small, where you were seeing these anomalously big numbers and, as recently as Q1 of this year, but also going back throughout the pandemic, companies have been raising large bridge financings in between rounds. Again, this reflected the large amounts of dollars available for late stage companies. So it reflected the heavy level of activity for the later stage companies. And this red bar coming down just indicates most of these post-seed bridges are between Series Seed and Series A rounds, again, relatively early stage. And we're not seeing a lot of bridge rounds between Series B and C, between C and D, which would tend to be larger if they were happening. So that's kind of the kind of high level state of the market.
Greg, absolutely fascinating. I think not necessarily what I was expecting from the last time that we got together. Good to know the sky is not falling across all domains, that there is still hope out there. Looking forward to diving into so much of those nuggets that were shared in these slides. And yes, for everyone who is curious, those slides will be available. We will be sharing them after the fact in follow-up today, and stay tuned for more. Before I invite our incredible experts to be joining us on stage, I do want to remind everyone we love a good Q&A here. So if you have questions as we're going on, if you have questions that Craig can answer from the deck, go ahead and throw them into the Q&A function that you're seeing on the bottom right of your screen. We'll try to get to as many of those as we possibly can throughout today's conversation. But to join us in conversation, we have two venture capitalists who are so well regarded, beloved by portfolio companies and entrepreneurs really throughout the States. I am thrilled to be able to introduce Brendan and Sudeep to the stage. Brendan is a founding general partner at Fuse. Sudeep is the partner at Decibel. Rather than butcher backgrounds, we always love to invite each of them to sort of share a little bit about their background and where they came. So Sudeep, maybe I'll invite you to start, and then Brendan will kick it over to you.
Sure. Thank you, Nicola. And hey, Craig, good to see you. Hello, everyone. My name is Sudeep Chakraborty. I'm a partner at Decibel Partners. We are an early stage venture firm that backs technical founders building technical products. I started my career as an engineer, an entrepreneur, and went on to start two companies that we grew and then eventually exited through M&A transactions. About 10 years ago, I switched to the venture side, or as some of my friends say, entrepreneur friends say, the dark side. And in that time, I really have had a great fortune working with several fantastic entrepreneurs building great companies. So I personally, through my firms, had invested in companies like Heptio and Temporal and Serverless.com, Exabeam, Menlo Securities, Botnana, and a few others. And then in my role of helping technical founders in the first 2-3 years of their journeys, I also realized the value of really meaningful help that makes a big difference between success and failure. So that's really what we are trying to do at Decibel. We are building a specialized firm that invests in the earliest stages, and nothing is too early for us. The earliest stages of enterprise infrastructure companies. So think of us as investing in startups that are building more horizontal products sold to CIOs and CISOs and VPs of engineering and so on. And we partner with technical founders, and we bring several founder services to accelerate their path to market, their product market fit, their customer acquisition, team building, all of that stuff. We are investing out of a $275 million fund right now, write checks anywhere between $500,000 to $10-12 million in a round. So, really trying to build a firm that I wish I had when I was a technical founder myself.
We love that founder first mentality here. Excited to dig a little deep into it as the conversation continues. Brendan, welcome. Great to have you. Would you like to share a little bit about your background?
Yeah, thanks for having me, and great data, Craig. Very much surprising. I'm one of the founding general partners of Fuse. We manage several $100 million to invest in technology companies, primarily focused in the Pacific Northwest. It's myself and two partners who started the firm. We're about 2 years into our journey, so very much founders ourselves, and so know what it's like to get on the fundraising trail for sure. Prior to this, I spent 9 years at global venture firm Headline. I managed several $1 billion investing in early stage technology companies. As I mentioned, our focus is investing in the Pacific Northwest region, where everybody else is investing over Zoom and trying to fly in and make a deal in a few hours. we try to build relationships with founders for a period of time and then invest. And we think that gives us significant edge over our competitors. So nice to meet everybody. And we invest from first day into companies through the Series A and lead almost every time.
Perfect. Well, I know we're going to have some questions here about how to build relationships, both in the digital setting and in the non-digital setting.
Yeah.
So looking forward to digging into that a little bit. But I'm going to start the conversation, Craig, with you. And I feel like based on the slides that you shared, we kind of need to have two chapters here. Chapter 1 needs to be sort of late stage companies, and chapter 2 needs to probably be early stage companies. But one of the most important things that is always on the mind of founders is time to close. We know fundraising is a full-time job. It's a full-time job in the best of days, let alone in the challenging days that may be around the corner. How are you seeing right now time to close? What is the effect, both for our earlier stage companies and for our later stage companies, on the efficiency of starting the deal and getting it all the way to the finish line?
It's a great question. And I actually wish that we tracked this data and I had a slide on it, because there absolutely is a direct correlation between how hot the market is and how quickly deals close. And so back in Q4, it was not unusual for companies to go from first meeting to VCs to sign term sheet in a matter of weeks, sometimes in a week, particularly on the late stage rounds. And then sometimes to close those deals in 2 to 3 weeks, which was insanity. And the last time I saw deals get closed that quickly was the fourth quarter of 1999, before the dot-com crash. I remember working on a deal right before Christmas of 1999, where same thing. The first meeting with the VC was on December 15th, and the money was in the bank before the year ended. And that's lunacy. It made no sense. Obviously, the investor did zero diligence. And by the way, that company ended up going out of business about 9 months later. Now that the market has changed, deals are definitely moving more slowly. And honestly, I think in a healthy way, that investors are doing more diligence before they provide term sheets. There's not the same sense of urgency, because that fear of missing out, particularly in the later stage deals, is just not there. And even once a term sheet is signed, getting from signing to closing and money in the bank is taking longer, and is honestly back again to a more normal 4 to 6 weeks from signing of a term sheet to money in the bank. And that's because investors are properly doing their due diligence on the founders and on the business itself, raising issues and making sure that any issues that come up in diligence get resolved.
That makes a lot of sense. Now, Sudeep and Brendan, I want to turn the tables a little bit over to you and invite you to maybe share on two aspects of how you're deploying capital right now. One, to existing portfolio. Are you finding that your current portfolio are kind of coming back home first and foremost to say, maybe we should be raising a little bit more from those that believed in us? Are you doing extensions into your existing portfolio, or how are they faring if they are going out and obviously trying to do follow-on financing right now? And secondarily, maybe what are you seeing as your expectations, managing expectations with new founders that are coming in, approaching you on trying to raise? Any changes in timelines or process over the last 3 to 6 months that are notable? Sudeep, maybe we'll start with you, and then Brendan, would love your thoughts on that.
Yeah, sure. I think on the portfolio side, existing portfolio companies, one thing we have been blessed with is, we are a fairly new firm. We are like only three years old. And because we only invest in seed and Series A, our portfolio companies are also pretty young. So as a result, they have a much better control on their burn and their, hiring, pace and all of that. So it's not, particularly triggered by the market condition, but in general, I think we always have kind of coached them, recommended them that, they manage their burn well, because at some point the market was going to turn anyway. So we feel pretty good about, our portfolio companies, not really, in a state of desperate need for cash or anything like that. And we keep a very close eye on that. I will say that some of our portfolio companies are probably taking a bit longer before they want to go and raise, because they want to just get the story stronger. Some of the data that Craig was sharing, like if they're raising a Series B, it's probably much better to have the story tighter. So we are also counseling that, and they're also kind of seeing that. And it's going to take longer to raise a Series B than it was 6 months ago. In terms of deploying new capital, I think Craig actually stole most of my thunder with his data on the early stage deals. In our world, and as I was saying earlier, we actually invest literally in two founders and their dog with an idea in a napkin. So that early, that early we go. So in our world, by the time the companies that we are investing in today, by the time they actually have a product and will go to market, it'll be like 18 months or beyond. So the market will be in a different cycle. Can't say whether good or bad, better or worse, but it will be different for sure. So that's one thing. So we are not particularly swayed by the market conditions as much. And then, we really focus on finding the best founding teams. And, the best founding teams, they can raise in any market, with the strength of their vision and the team. So our current, deal pace is roughly 8 new investments a year. I see no change this year at all. If anything, we might actually, be at 9 or 10 this year, because, choppy markets are often the best times to start new companies. Talent is a bit more available, loyal. Customers are looking for innovative solutions because they don't have large budgets, to build the same product inside. And then, your competitors are not raising boatloads of money and creating noise. So that's why, in our early stage world, it is really a really good time, optimistic time. Now, if you're asking me about Series B and C, which we don't get into, you will hear a completely different answer for sure.
More to follow on that, I'm sure. Brandon, what about you?
Yeah, same deal as Sudeep on the really early stage, the 2 guys and a couple dogs. Yeah, those folks are going to continue to get the cash. We just had 2 founders in that we're really excited about, and we're moving at the speed of light to potentially invest in the company. The Series A, we've seen a little bit of a slower pace on the Series A. We think some of the seed stage companies they're not going out to market until they hit certain metrics. And so we think the pacing will be a little bit slower. Most of the capital of our fund goes into companies that have a product in the market and some revenue. And so that's very much the Series A stage. So we think the pacing will be, a little bit slower there. As it relates to the investing in the portfolio companies, it's the tricky part of the business, right? You want to be supportive to founders. At the same time, you have to be really careful about those bridge rounds when companies, they just they haven't gotten to where they've needed to go. And so, supporting them may not really be the best thing for anybody. How we think about the dollars that we have in our fund, it's really, about how do you get the highest rate of return on those dollars invested. And so you're proactively investing in the things that you think have a lot of potential, if they can use that capital to grow really quickly. We even tried not to use the term bridge anymore because it almost has a negative connotation and feeling to it. I want to feel like I'm investing in something that's got momentum, and happy to get them to, maybe a higher valuation at the next round. But we're quite prescriptive around how we manage those follow-on dollars.
Mm-hmm.
Nicola, can I add one little thing that we are seeing on the deal dynamic side? And this is actually more true in the last couple of months. We're actually seeing some companies that probably wouldn't have come to the market unless they're raising a $15-20 million Series A, are having a little more openness to like a seed plus or a, kind of an intermediate round. And, frankly, those are like great opportunities in many cases. And these are not bridge rounds. These are more like, equity rounds, price rounds that help them, kind of really set up for a much, more attractive Series A, like a year down the line. So you see that happening a bit in the market, at least in our world.
Interesting. Well, both of you have alluded to, maybe more than alluded to, the importance of sort of the coachability around, meeting milestones, managing burn, being careful. Before flipping to the next series of questions, I want to double down there and just ask, are you encouraging founders to think differently about how much runway they really need in the market right now? Has the length of time of expectation between trying to raise the next one shifted at all in the conversations and ways in which you're approaching looking at financials with the founders that are coming through your doors right now?
I can start. I don't really like talking about like the runway, in the form of months, because it's very it's an extremely dynamic thing, right? Like it's all tied to revenue and hitting targets and how much you spend. So, we have the plan, and I think there's a certain amount of risk with every type of business. And, a software company that's got 5 million in revenue, I mean, it's never going to die, right? So maybe you can take a little bit more risk with that business and shrink the, in quotes, runway. But our perspective internally is that these businesses need to be growing really quickly. That's what the growth investors really want ultimately at the end of the day. And so we can't give up on the aspirations to be the category defining company. And so we work with them to try to hit those numbers. And we won't extend runway, unnecessarily if we don't need to.
Love that. Love that. Inside the minds of VCs, which is always hard for founders to kind of get that honest, earnest look when it comes to like, what do they want to see? What should I be presenting right now? Is it about months? Is it about burn? Is it about milestones? So really,
about the plan.
Yeah, exactly. All right, Brendan, I'm going to stay with you just for a second because you already said you're about building relationships. I know everyone here is about building relationships, but in your world, it might mean something a little bit different than Sudeep when it comes to like how you get to meet founders virtually or in person. So for many on this call, for many that are around this call and will be watching later, they may be first-time founders. They haven't got necessarily the deep network. What advice do you give a first-time founder or even those that are approaching you on how to really build meaningful connections with venture capitalists, and maybe even how to build that first strategy of who do I approach and how do I even start the conversation of, please, can I have a meeting with you so I can get money because I really need it?
Yeah. Well, I think everyone reads their emails. All the best investors in the world read every email that comes in. And if there's relevant, context to why they're reaching out, based off of things that we've worked on in the past, that's the number one thing that's going to, get people's interest. Definitely, some level of traction or just relevancy around what this person's doing and what they did in the past. Those are the things they really need to highlight. The email can't be too lengthy. But that's sort of the way to engage. If you're going to go in cold, every VC always says, hey, get an introduction. I know how hard that is though. Right. So I'm not going to say that, but everybody on our team, we look at every single email that comes in. And then if we have a coffee or if we have a Zoom, that's awesome. But then it's about the follow-up. We love when we're added to email updates every quarter from companies and CEOs who are sharing what's going on. It's a really great way for us to passively stay in touch with the companies and help prioritize the prospects for ourselves. I mean, we have thousands of companies, so does Sudeep, so does everybody. So anything that helps us manage that prioritization is really key. And then, also working through problems, happy to get on a call with people if I can actually help out. That's a good way to build a relationship. But the most of the time, the GP is only going to have so much expertise, right? So, it's about those asks and making the time when it's relevant.
I would not be doing my job if I did not call out that these two incredible experts joining today were introduced to the center because of Craig. So also don't forget the importance of building relationships through your amazing service providers and your supporters and your other champions that you have around you as founders. And so Craig, I'm going to turn the switch back to you for a moment. A lot of our founders often worry, rightfully so, from mythology and from reality about IP. When you're in conversation with funders, you want to be transparent, you want to be earnest, you want to be honest. It's really weird asking for an NDA. Most everyone has heard the thing, we don't sign NDAs. So what advice and guidance do you give to founders who are finding themselves in this worry spot of how much do I talk about, what do I not talk about, and how do I make sure that I'm protecting what I need to for the benefit of the company and all the employees that I hope to have around me someday?
Yeah. So Nicola, you mentioned that VCs won't sign NDAs, and that is generally true. I advise founders that I'm working with not to ask for an NDA. It will be kind of insulting because the reality is people like Sudeep and Brendan are talking to companies every day. They're talking to founders every day. They can't be worried that somebody's going to show up 4 years later and say, you funded this company that was in my space and you stole my idea. And it's based on trust. You ought to go into a meeting as an entrepreneur with a VC, having done some diligence on the VC to know that this VC is trustworthy. Most VCs care deeply about their relationship, about their reputations. And if a VC was known for stealing information from founders of a company and using it to the benefit of another company, no one would ever talk to them again. So make sure that you've talked to others about the VCs that you're planning to have conversations with to know that they're trustworthy. And you should go in knowing that you're in a situation of trust. Second, release the information slowly. You're not going to get a term sheet after that initial meeting. So you need to make sure that you're talking to a potential investor and providing them with enough information that they can decide whether there's something of interest here and they think they could be helpful and might be willing to invest. But they're going to take a second meeting first before they decide to write you a term sheet. So spread out over time the information that you're providing and hold that most sensitive information first. You don't need to talk about the nitty-gritty details of your technology, your true secret sauce that you're in the middle of patenting. And if you haven't filed a patent yet, or you are in the process of filing a patent, make sure that you talk to your patent attorney about what you can and cannot disclose, because you actually could blow up your ability to get a patent issued if you disclose too much information that you're about a patent that you're trying to file. And VCs understand that, and they're not going to force, certainly in a first meeting, you aren't going to get down and start reading code together. So make sure you're spacing that out.
You may be able to. I can't.
But I still moonlight as a coder sometimes. So yeah, I've been accused of that. I mean, one thing that Craig just mentioned, I would just double click on is if you ask any investor, at least the savvy investors, they will say trust is the only capital we have. So it really goes against the grain of what we do in terms of partnering with founders. If we are stealing ideas from one to give it to another. I know there have been some instances that definitely come up in the media, but by and large you will not find that, because it's very hard to move away from that kind of reputation once you get it. So yeah, I mean, that's what I'll pause. But yeah, signing NDAs is a slightly different thing where you have to be really careful about what you are talking about with one company versus another.
Well, Sunil, I'm going to stay with you, because one of the things we often commit to in trying to better understand at the center is how do we really help founders find their founder market fit, right? And that can mean different things to different people. You've been both operator and now turned not to the dark side, but to a great side and supportive champion entrepreneurs who are building great companies. How do you help them think through founder market fit? And how do you think about that word, both from both sides, as investor and as an operator in that space once upon a time too?
Yeah, so I want to call out one thing first, just my bias here. Like Decibel is a very specialized firm. So meaning like we invest in one area, which is enterprise infrastructure. And we kind of, invest with deep convictions, meaning like, a lot of the work in terms of building conviction happens even before we reach out to a founder or meet a founder. So in our world, founder market fit is probably one of the most important things that we look for, because, you can't just, fall out of a tree and start a really interesting enterprise infra company tomorrow. It just doesn't happen. So typically the path our founders take is, and it's actually pretty much the same path with some variations, is he or she is typically an engineer, rockstar engineer within a somewhat of a larger company, not necessarily the FANG companies, but at least some fast-growing companies that is encountering the problem maybe 2-3 years before the rest of the market does. And then he or she has built a solution internally that has gotten battle tested inside that company. And then, they kind of realize that, well, maybe the rest of the market needs something like this in 2 to 3 years. So that's the perfect time when they come out and start a company. So that founder market fit is probably one of the topmost things on our minds when we are, deciding to invest. So, without that, like most of our companies will not succeed. Like you really need to know not only why this will work, but you also need to know why this didn't work last time around and why now might be the right time to do this.
There have been many challenges, to say the least, with the pandemic for founders. One of the interesting dynamics that we've watched through this series and others over the last couple of years is that geospecificity, as far as who one reaches out to and how you think about who you should be approaching has fundamentally changed. I think the model of venture from LPs, the funders of the funds, all the way through to the deployment of the funds has changed. Brendan, I want to start with you, not asking you to go on the record as saying this is what we do, but how have you seen Zoom and digital first and this openness to geography shift with the way that either your current companies are thinking about raising? And also, what advice do you give to founders now that in some ways their market has gone maybe from this to like this, in thinking about how to approach and who to approach in fundraising now that geography may not be the once bound constraint that it was for a lot of entrepreneurs?
Yeah, I think it opens up the opportunity for founders to talk to the right potential investor who understands a category. I think the future of venture capital, from a performance standpoint, people are going to do really well, or people that are really tight on a specific category, like Decibel's thesis is very, very clear, or people focused on a region where they can meet people in person and build those relationships and get to know them over a longer period of time. And so Zoom enables people to go find the category experts, and they can, have those catch-up calls as frequently, and frankly, with just in a more time efficient manner than grabbing that coffee. And so that's obviously helpful, but at the same time, I think there's a lot of investors who invested last year just purely off of Zoom, and they never got to meet the person in person, and they may regret it potentially. And so I do think it's going to shift back to where the VCs are going to go get on the airplane and go meet the person before necessarily issuing a big term sheet, or the person's going to fly back to Sand Hill Road. So I think there's going to be quite a bit more of that the next few years.
Yeah, really interesting. I'm going to jump from the philosophical down to the super tactical, just because sometimes the tactical can really help arm our entrepreneurs in the best of ways. Do you find that pitch decks are run differently, or would you encourage entrepreneurs to think differently around how they approach the actual pitch in a Zoom meeting than perhaps once they did across a big conference table where you could read the room, quote unquote, a little easier?
I think you have to know, who you are and what your skills are. If you're a phenomenal storyteller, you can get on that Zoom and make those 20, 30 minutes be incredible, but most people don't do that very well. And so I'd recommend using the deck after some quick pleasantries, just to make sure that the founder is able to hit on all the key points. A lot of times we get off the phone with folks and we just didn't get there on, the differentiation, and maybe we tried or we just didn't have enough time, but that's really important, right? For the investor to have a good sense of the market, or, because it's very hard for VCs to do a lot of market research. And so if they don't have much intuition about the company coming out of the meeting, it's very hard to be prioritized. Mm-hmm. And it could just be one little nugget that gets, me to spend the extra time about it. But if I feel like I just don't know enough, I can't, it just goes to the bottom from a priority standpoint. I can't spend time on it.
Yeah, so there's gold for everyone listening today if they don't know enough. So double down on that.
That's the whole thing.
I want to invite you too, because I think this is just something that entrepreneurs worry about asking for feedback on, or you just don't know what didn't land. Any guidance that you can offer entrepreneurs from thinking through a Zoom meeting and preparing well, or the pitch deck itself, that super tactical stuff that actually matters in getting the next meeting, not getting the check, but just getting the next meeting?
Yeah. So first of all, I think, this whole dynamic is here to stay. We see that every day for the first meeting or even the second meeting, it is going to be on Zoom. Founders are not, even if you're in San Francisco and I'm in Menlo Park, they're just not going to get in a car, and spend an afternoon for a meeting that may not be a mutual fit, right? So I think you really have to learn some new skills in the Zoom era, particularly for the first and second meetings. Number one. Number two, I think, the part that becomes harder is how do you showcase your rest of the team on Zoom? Mm. In a conference room setting, that used to be much better. You bring in your co-founder or co-founders and, the investor. And it's really important for us to understand, the complementary skills of the team, the chemistry within the founding team, how they work together. It's much harder to do it on Zoom, because maybe it's only the CEO speaking. So I think entrepreneurs really need to think through how they have to divide some of the conversation without introducing too many disconnects in the Zoom era. Because as an early stage investor, I am really betting on the team. So I really want to know, not just you as a CEO, but the one or two co-founders that you have around you. So I think that's a really key thing. I would also say, the other thing is, it is really important for us to get to meet the team in person at some stage. And we actually take it upon us to go and make that happen. And just so you know, Decibel actually invests virtually anywhere in the world. And because we invest in open source companies, like our last, couple of open source investments, one has been in Italy, one has been in Spain. So it's like, we really have to go where the, best engineering teams are. We take it upon ourselves to go and, meet them. Doesn't mean a lot of great vacation trips or anything like that, but we try to make it happen when they are coming to the US for a conference. We go out of our way to fly in and meet them. I think that part you can never really take out, to Brendan's point, because this is a longer term relationship than even the average marriage, right? And unless you really get comfortable on both sides, it's very hard to pull off. So
yes, we use that in our pitch deck, by the way.
What is that?
We use that. This is a longer relationship than
you have a chart, right? You say average length of marriage.
Yes.
It is true.
We don't have a chart on it, but we always say that.
Adjunct in the ER report, we'll have that as we track and trend.
True.
Yeah, it's true.
No, it's absolutely true. And I think especially in good time, well, good times last, but the harder times, right? When you're not sure, it's tough to be able to have those same open, honest conversations if you don't have that relationship going in. So.
Yeah, but I also think fundamentally something has changed where expecting a founder to take an afternoon or more for the first or second meetings, I think is unreal going forward.
Yeah, no, I appreciate that. Fully appreciate that. All right, Craig. Well, I would not be doing my job. We're already so far into this, and it's been just a great conversation already. But we haven't even talked about valuation, and I feel like that's just shameful in the biggest ways. I want to come down to you and ask. Valuation trends, you talked a little bit about it, obviously, in that great slide that arose. I think definitely some surprising elements. What else did we not get to in that slide that you would call out right now as far as valuation trends that are emerging? And then not asking you to be always perfect at prediction, but I'm still going to put you on the spot. Say, what do you think the next 6 months are going to look like, and where are we heading at the valuation layers?
Yeah. So I expect the trends that we talked about earlier to continue, that the early stage valuations are going to continue to be healthy because they weren't that bloated to begin with. And because there still is a lot of dry powder out there. There's still a lot of funds like Brendan's and Sudeep's funds that have cash available and are excited and willing to invest because they recognize a downturn is a great time to invest, particularly in early stage companies where the cycle will turn. Investors in later stage companies will start investing again. And that will be at the time where these companies that are just getting their seed now and their Series A now need to raise the next round. So the timing is good for early stage. I expect that late stage is going to continue to be a challenge, and there aren't nearly as many dollars available as have been available, and companies need to continue to hunker down a little bit. I love that Brendan said that he was company specific about how much of a runway his portfolio companies ought to have, because I think every other VC in the country must have attended some NVCA, National Venture Capital Association seminar where they were told all companies must have 2 years of cash, because every single board meeting I went to between I think starting in June until now, the first conversation is, how much cash do we have? No matter what, you have to have 24 months, at least 24 months. And I don't know where all the VCs got it from. I think it's because all the boards interlock, but everyone other than Brendan, I don't know about Sudeep, so didn't weigh in on this, but everyone else has been saying 24 months. So it's good to see a little bit more thought put into that. It's not a blanket rule that companies are very different from each other and have very, very different needs.
On that point, just real quick, just sorry to interrupt, I think very much like Brendan, we actually recommend to our companies to really think about the story they want to pitch at the next round, not the round they're raising now, the story they want to tell at the next round. What are the 3, 4, 5 milestones they want to hit? And then back calculate and see, how much runway and cash and team and all of that they need.
Yeah, we love that. The continuum is so important, right? It's not about going from point A to close of exit. There's so many very important interludes along the way. Gosh, time is going too quickly, and there's so many good questions in the Q&A I'm going to get to. All right, so I'm gonna do 2 more questions. First, though, before I let you off the hook, Craig, what other important shifts in term sheets or other things have we not talked about maybe that are emerging or on the horizon or are happening right now? I know last time we had some really interesting conversation around some terms that were showing up that hadn't shown up for a while, again, mainly in our chapter 2 later stage companies, but anything emerging in early stage or late stage term sheets right now that our entrepreneurs and VCs should be aware of?
Yeah, I mean, what we do have a chart in the entrepreneurs report. If you click on the link that's in the chat, you can go look at the details. And there's a chart that I didn't put up on the screen because it's a real eye chart with, what percentage of deals have a participating preferred versus a non-participating preferred. The real legal, the details of the legal terms of a financing. Last quarter, we talked about, I had mentioned a deal that I had worked on where an investor showed up right before closing, that the day before we were going to close, and said, the market's changed and we know it's normal that investors are guaranteed their money back before the founders get anything. We want to be guaranteed double our money back before the founders get anything. And I had not seen an investor insist on that since the early 2000s, after the dot-com crash. And that ended pretty quickly after the dot-com crash because most investors realized it was counterproductive, that if the management team and the employees are aware that they're buried under a bunch of liquidation preference, so that when the company is sold, their equity is likely to be worthless, it's demotivating. Part of the reason that founders join startups is not just because they're passionate, but because they want to get a good economic return on the time that they're spending working on an early stage startup. And they need to know that they have a good opportunity to realize something on their equity. And that's the most egregious term that you could possibly have, where investors are guaranteed a significant return before founders get anything. I thought that we were going to start seeing more of that. And what's interesting, and you'll see in the deal report, if you dig into the eye chart, is that deal terms haven't changed very much. That liquidation preference, other than that one anomaly I mentioned with the 2x liquidation preference, are still mostly founder favorable. Most of the terms that I would have expected investors to insist on in later stage deals to give them more protection, there's a little bit of that happening, and you can see that a little bit in the numbers, but not nearly as much as honestly I'd expected. I thought investors were going to be more demanding. And frankly, I'm relieved because I think it's a healthy sign for the market that VCs are recognizing that if the terms that they impose are too onerous, it's demotivating for the team. It also sets a bad precedent for the next round, because if the terms are too investor favorable in the Series A, they're not going to get more. They're not going to get less investor favorable in the Series B, and it actually hurts a Series A investor if onerous terms that they impose in the Series A are repeated in the Series B, because the Series A investors will be buried underneath that. So I'm cautiously optimistic that investors are being rational and are not going overboard yet.
Investors are always rational, right? Isn't that I'm teasing. And it's always true with our panel today. All right, here's the last question, and it's a two-parter, and I'm gonna start with Sudeep and then go over to Brendan. The question is this: what are you most optimistic and excited about for the remainder of the year? It can be specific within your portfolio and or specific to the market, depending on how you look at it. And then what's one final piece of advice that you would offer to the founders joining today who are probably, for most of them, struggling still with this fundraising process and are not yet in the camp of having seen that doubling down on valuation or that doubling down on the amount of capital in their bank account just yet? So would love to invite you to start. And then Brendan, that question is coming over to you too.
Yeah, on the first aspect, what I'm optimistic about, I'm actually really optimistic about kind of the noise reducing a bit, because we invest in early stage companies. They need some time to really put their heads down, build the product, build the team before they go to market. So I think when the market some normalization in the market happens, it actually helps the early stage companies that really have a solid product, solid vision. So I'm really optimistic about that because it really helps the good companies. I think in terms of one piece of advice to founders who are raising, look, this is true now in this market, but it's also true in any market, which is like always having more proof points help. Now, if you just have an idea on a napkin, then try to get as many customer discovery conversations as you can have to tighten the pitch to show some robust market demand. If you have a product for folks to try to get more POCs if you can. If you have an open source project, try to get the community adoption go a little further, collect metrics that shows that, right? But I think overall, I think the underlying theme is great teams always get funded, no matter what the market is. So if you feel like you have the room, you have the opportunity to bring on a great co-founder, if you're a solo founder and have a great co-founder, who you might be able to bring in, bring that person in. It strengthens the story quite a bit for sure. Because honestly, finding a great team never goes out of fashion.
Love that. Amazing. Thank you so much. Brendan, over to you.
Yeah, I think I'm as excited as I've ever been. I mean, it's amazing that we get to do this every single day. I mean, just to have capital to invest in companies right at the very beginning of their journeys is really the key. We're so far removed from the public markets that those things don't impact us day in and day out. We get to sit there and work with people that have big dreams, and so just getting to do this and work with people is what I'm excited about and what the whole team is excited about. I think the big the piece of advice, and when we always talk about it here, is you have to make the ask for capital, right? The reality is there aren't a whole lot of venture capital firms that invest in seed stage companies. Unfortunately, it's not a very big universe. There aren't a lot of seed fund managers. And so when you're meeting with individuals at that early stage, you got to make the ask, do you want to invest, and if not, or if they do, ask for the referrals. And it's very much a sales job at that very early stage, because the number one thing is staying alive and having the ability to get that product to market, to go hit on those the items that Sudeep was talking about. But certain things like an open source product, you can probably work on while working at your current employer and get some traction. That would make fundraising certainly a lot easier. But that would be the one tip, which is just make the ask.
Can't be successful if you don't make that ask. Such
Yeah.
good salient advice. Craig, I'm going to round it out with you before I say a huge thanks to everyone for their time today. Advice: you see the numbers, you see the hearts, you hear the stories from the founders directly, the struggles, the challenges, and the wins, and the losses too sometimes. So what's your advice to founders who are in the process of raising right now? Both you chapter 1 and chapter 2. So from our early stage founders and for our later stage ones too.
I think my advice would be the same for both. You got to be tenacious, and you got to be politely tenacious. You can't be rude to potential investors, but you have to recognize that the market is a little bit more difficult. Even though I talked about the numbers looking pretty good on early stage financings, the numbers are horrible when you look at them in the aggregate in any given quarter. Most entrepreneurs trying to raise venture money do not raise venture money. So you have to be patient, tenacious, but you also have to be realistic at some point. And if your pitch isn't working, you have to think about why it's not working and what you need to do to readjust.
Being tenacious is one of the most important skills of our entrepreneurs, for sure. And speaking of making the ask and being tenacious, I got one more for our founders who are joining us today. As you know, we develop programs specifically for what your challenge areas are. What is keeping you up at night? We hope you get good night's sleep always, but we know sometimes that's really difficult to do as founders. What you tell us today is going to go into the aggregate of other programs that we are building right now out for the next 6 to 8 weeks. So again, your honesty, your transparency, and letting us know what your struggles are will help our program team here at the center develop those programs, bring in experts like we've had today to answer your questions and to make sure that we're keeping you sustainable on this journey of entrepreneurship that you've all committed to. And on that note, a huge thanks and appreciation to our incredible panel that joined today. Sudeep, Brandon, Craig, as always, thank you so much to each and every one of you for your time, for your energy, for your passion, and for the humor that emerged as we went through this. I really appreciate it. All the team at the center does, and I know each and every founder here does too. Thank you so much. And to our founders joining, we appreciate you. We'll be following up soon with all the information we promised, and we'll see you and welcome you back to the center again very soon. Thank you, everyone, so much.
Thank you so much.
Thanks.
Thanks all.
Thanks.
Thank you.
Bye-bye.